Although annual headline inflation dropped below the 5% mark at 3.9% in July, following effective monetary tightening, and the central bank rate currently revised to 9.5% from 10% prior, Bank of Uganda has confirmed a drop in economic growth, as earlier on demonstrated by Uganda Bureau of Statistics at negative 6.5% for consecutive quarters, attributed to measures taken to tackle inflation last year and current multi-sector challenges that have inspired limited private sector credit.
We've been pursuing a tight monetary policy, and so has government been undertaking fiscal consolidation. Now, we know that the transmission mechanism of monetary policy in our case is anywhere between 12 to 18 months. So some of the actions we took last year are now beginning to play out. So that is affecting the aggregate demand in the economy. If you look at the private sector credits, private sector credit growth by end of June was only 6.5% compared to where it used to be of somewhere near 10%. So we think that the impact of this has been to tighten the credit conditions, notwithstanding also the fact that most of the financial institutions have become sort of like risk averse, given the fact that the quality of the assets has been affected by the COVID-19. They have had to make some provisions against that. And then also,
according to Adam Mugume, the Executive Director Research at Bank of Uganda, the slash in cash reserve ratio for commercial banks by 50 basis points to 9.5% further boosts the financial sector as banks look at improved liquidity to support private sector lending, where trade, manufacturing, construction and agriculture, for instance, pursue a progressive curve.
Reducing the CRR alone by 50 basis points would mean that you're injecting, looking at the deposit available, the deposit in the commercial banks, we are talking about an injection of around 160 billion Uganda shillings, just on back of envelopes calculation. So that liquidity, in combination with reducing CRR, which also means that the banks now have more liquidity, we believe that that will have some impact on liquidity available to the banks for on lending. It may not be immediate in terms of lowering lending interest rate, etc., but at least as it should be able to ease the liquidity available to the banks, which then can be available for on lending. So we believe that that is the right direction, given that the demand is softening.
As the country sustains World Bank's definancing for new projects, fear of impact on the shilling and gross economic progress still looms. As per the central bank, joint monitoring of the situation with the finance ministry is on course to ascertain impact that goes as far as on the foreign exchange market.
Until we get a firm information from the Minister of Finance regarding the exact amount of the resources that are affected, it would not be proper for me to speculate on what the impact is going to be. And also we want to know how is the Minister of Finance going to respond to whatever cuts have been made. My understanding is that most of these cuts relate to projects that are yet to be approved by the World Bank. So it therefore means that maybe they have not yet been budgeted. All right, for if they're in that are budgeted.
Ultimately, the central bank envisions up to 6% economic growth in the current fiscal year as the private sector gets back on feet, coupled with oil and gas inflows plus export growth. Ivan Tivenkana, Smart 24 TV, Business Today.